Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is July 28th, 2025, and this is your host, Brent Foster of the Northbound Wealth Podcast, as well as the founder and CEO of Northbound Wealth Management. And this is our weekly Insights 113th episode. Let's dive in. Expectation beating second quarter results from several companies, trade updates, and investor optimism for more trade agreements pushed market averages to solid gains and record closings last week. This week, the focus is on Big Tech Mag 7 earnings reports. So let's review last week. Earnings trade lift markets. The S&P 500 index rose 1.5% this week to another closing record in a broad advance led by the healthcare sector. The NASDAQ Composite Index added 1.02%. Dow Jones Industrial Average rose 1.26%. The MSCI EFA Index, which tracks developed overseas stock markets, gained 2.16%. The index ended Friday's session at 6,388.64, the highest closing level ever. That marks the benchmark's fifth consecutive session, closing out a record high. The S&P 500 also recorded a fresh intraday high on Friday at 6,395.82 and is now up 3% for the month and 8.6% this year. It's been a good year. The U.S. announced trade deals with Japan and Philippines this week. The U.S. also had a 50-50 chance of making a deal with the EU. President Donald Trump said Friday ahead of a meeting on Sunday with European Commission President Ursula von der Leyen. A number of stocks were also boosted by better than expected quarterly results. All of the S&P 500 sectors rose. In the lead, healthcare climbed 3.4%, followed by materials 2.4%, and industrials up 2.3%. Real estate and communication services added 2.2% each. Financials, energy, and consumer discretionary added more than 1% each, while utilities, technology, and consumer staples also edged higher. The best performer in the healthcare sector was West Pharmaceutical Services, ticker symbol WST. Shares jumped 25% on the week as the company reported second quarter results that topped analyst mean estimates and boosted 2025 guidance. In materials, Newmont shares climbed 13% as the company reported second quarter adjusted earnings per share and sales above analyst mean estimates. GE Vernova, which is ticker symbol GEV, had the largest percentage gain in industrials, up 12%, as the company reported second quarter earnings per share and revenue above analyst mean estimates. And they also said that it now sees the year's revenue towards the higher end of its guidance range. So check those companies out. Let's talk about the markets again. Let's see. The NASDAQ year to date is up 9.44%. S&P 500 is up 8.98%. Dow Jones up 6.05%. MSCI EFA is up 22.67%. So you got this international outperformance relative to the United States just this year, and that doesn't happen very often. As a matter of fact, the international markets are, I guess, playing catch up now, and we'll have to see if this is a lasting turn because they've underperformed for like 15 years. So, not exactly a great trade. You had to wait 15 years before it actually did anything. So pretty much, I mean, there's some argument here and there, but come on. All right. So 10-year treasury notes at 4.4% at last week. And that's up from 4.29% a month ago and 3 months ago and 4.27 1 year ago. So we're up a little bit. Thank you, Y Charts. A tale of two houses times two. So I'll explain what I'm talking about there. When fresh housing data emerged this past week, one number stood out. The New homes are now nearly 8% cheaper than existing homes. Did you hear that? New homes are nearly about 8% cheaper than existing home sales. The median sales price of a new home in June was $401,800 compared with $435,300 for an existing home, an all-time high. Home builders have been reducing prices in an attempt to attract potential buyers. But there's another tale of two houses, national versus regional. Existing home prices rose 2.7% last month over May. In the Northwest, where inventories are still constrained, prices rose 4.2% in June. However, the market is softening in many other regions of the country. And in the South, for example, prices rose 0.3%. Homes stay on the market for longer and inventory rises, leading some to conclude that it's a buyer's market. All right. This week, key economic data. Economic data will include second quarter gross domestic product. That's a good number to look at. The June personal consumption expenditures index, or the PCE, and July employment data. So, more specifically, Tuesday, trade balance in goods, consumer confidence, Case-Shiller home price index, retail inventories, wholesale inventories, job openings, the FOMC meeting, day one for July. Wednesday, ADP employment report, gross domestic product, Treasury refunding announcement, pending home sales, FOMC July meeting on day two, FOMC interest rate decision, Fed Chair Powell press conference. So let's see what Fed Chair Powell has to say this week. Jobless claims Thursday, personal consumption, that's that PCE on Thursday, employment cost index, and the Fed balance sheet. Friday, July employment report, ISM manufacturing index, construction spending, and consumer sentiment reading for the end of July heading into August. This week, notable companies reporting earnings. You've got Monday, which is today, Welltower Waste Management. Tuesday's Visa, Procter & Gamble, United Health, Merck, Booking Holdings, the Boeing Company, Spotify, Starbucks, and American Tower. Wednesday, you got Microsoft, Meta, Qualcomm, Lam, that's Lam Research Corporation, ADP, or Automatic Data Processing, Altria, and Robinhood Markets. Thursday, we've got Apple, Amazon, MasterCard, AbbVie, S&P Global, Stryker Corporation, Comcast, KKR, KLA, MicroStrategy, the Southern Company, Coinbase, and Bristol Myers Squibb. Friday, we got Berkshire Hathaway, ExxonMobil, and Chevron Corporation. So, guys, it is a power-packed, slammed week. A lot of earnings coming out, and it's exciting. You got the Fed going to talk. You got Trump trying to do deals. You got all kinds of activity economically going on this week. So pay attention to the markets. All right, tax tip of the week. Should you classify your workers as employees or independent contractors? You might hire employees and independent contractors for similar work, but there are differences in how they are classified. Here are just a few questions to consider. So, does the company have the right to control what the worker does or how the worker does the job? Does the business director control the financial and business aspects of the worker's job? Are the business aspects of the worker's job controlled by the payer? Are there written contracts or employee type benefits such as a pension plan, insurance, and vacation pay? Will the relationship continue? Is the work performed a key aspect of the business? Correctly classifying your workers is key when managing issues with taxes or liability. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional, and this tip was adapted from IRS.gov. Thanks for listening. We got a good show for you this week. Take a listen. Hey everyone, I do like to look at this every month. It's the Factor and Strategy Flows Performance by Y Charts, and I know you guys don't have this data in front of you, but it's a really good heat map indicator of what and where money is going around the world in different securities and indexes and types of instruments. So I wanted to just touch base on some of those key takeaways. So it looks like definitely money around the world is flowing into the S&P 500. That is for sure. That S&P 500 index, year to date has taken in $52.49 billion. Over the past year, that's $230.01 billion. Over the past 3 months, $11.14 billion has gone into the S&P 500 index. And over the past month, $7.82 billion. And so the S&P 500 is definitely a place people are moving money. Another place people are moving money is into large cap growth and large cap core, exchange traded fund strategies. So that might be not just the S&P 500, but other indexes that are similar to it. There is money leaving the small cap space on a year to date basis, and that's it looks like that trend is continuing. And so that stood out to me a little bit too. It's like we'll have to see if the market turns and small cap becomes a place that money begins to go. The same with the healthcare space, even though it is up, as you heard previously in the podcast, it's only up because it has been absolutely beaten down. Biotech and healthcare have not been good places to be in the market. And so I just want to point that out. And also, let's talk about, just in many areas of the fixed income space. So bonds, different types of bonds. I'm not going to go through all of it. It's a lot of data and kind of boring, but short U.S. Treasury. So short dated U.S. Treasury instruments has taken in $34.73 billion year to date, which I find interesting. A lot of intermediate term core plus fixed income is doing really well. Core bond is doing really well. So those ETF flows are picking up steam, meaning people are going out and grabbing duration when they can, as interest rates are higher, locking in those higher yields. Money's leaving few areas here. Let's see here. What is that one? Converts down 847 million. 1.23 billion down would be emerging markets, hard currency debt, flexible income. Looks like general U.S. government. Some of those spaces are in the red. So it looks like there's some redemptions there and reallocation of capital in other areas. Multi-sector income is doing actually good and trending that way on the active management side. So that is something that I also look at. And there's been in the equity space, a trend from over the last decade or two from active to passive, which is the exchange traded fund, passive management, tax efficient strategies that way. And then less and less active management going on. And so you see some cannibalization of the active space of money moving to the passive space. And then in fixed income, which I just went over, it looks like there's more and more of that as well, but less of it. The rate of change of that is less than the equity space, moving from active to passive management as more instruments are created. Looks like more adoption in the passive space is happening, but I see that like less of that happening with the fixed income because fixed income does benefit, I think, from having some active management versus passive. All right, as we dive into geographic peer group, like around the world, global, international markets outside U.S., it looks like a space that's really trending in the right way is the two-pronged approach. It looks like international multi-cap core. So what that means, large, mid, and small multi-cap core indexes taken in $23.76 billion year to date, $41.7 billion. 1 year trailing in the last 3 months, $10.4 billion. So actually taking in more money over the last 3 months than areas like the S&P 500 index space. As a comparison, it looks like European region is taking in some more money, and so is some of the emerging markets. EM, 9.3 billion, European region, 10.3 billion year to date. So that kind of stands out to me. Money losing is in some of the Pacific region areas. It looks like there's some money moving around that way, and like $575 million is out of outflows, 1.47 billion in outflows with some international small mid-cap core. So you got to kind of get under the hood to see some of those shifts in money flows around the world. Looking at the US sector, it looks like definitely year to date leadership would be science and technology space has taken in 3.44 billion, telecom 1.79, utilities 2.7 billion. That's all in the green. And what's losing money, it looks like, would be natural resources and healthcare. Biotech is, natural resource down 8.6 billion, healthcare biotech down 5.5 billion of outflows. Financial services has taken a little bit of a hit, but on the year is still up. So a little bit of a hit means 3.9 billion year to date, but then over the past 12 months, up 5.43 billion in inflows, net inflows. So seeing that consumer services and some of the basic material space is kind of negative, but not out of the ordinary on that. Real estate is kind of a neutral to green space. Some outflows there, but net positive on the margin over the past 12 months or 1 year. So for what that's worth, I hope that's been helpful. I like to look at that to see where the puck is going and be able to get ahead of trend, make adjustments as needed, and on to the next segment. Thanks. If you have or know a young person earning money this summer, you should share this information with them. For young adults, a Roth IRA can be a powerful retirement savings tool, but most don't understand how it works. Here are 6 things to know. Number 1, you contribute after-tax dollars and your money grows tax-free. Number 2, you don't need a full-time job. Any earned income, even from a part-time or freelance job, qualifies you to contribute. Number 3, contribution limits are separate from your 401k. In 2025, you can contribute up to $7,000 to a Roth IRA, even if you're also contributing to a 401k. Number 4, you can withdraw contributions anytime. Unlike many retirement accounts, you can pull out the money you put in, not earnings, without taxes or penalties. 5, you can start small. Even $50 a month can make a big difference over time. And number 6, you could consider helping them get started by offering to, say, match some of their money if they're interested in opening an account. So, key takeaways: starting a Roth early can give young investors a massive head start, offering flexibility, growth, and tax advantages few others accounts out there can match. Once you turn 73, you must take required minimum distributions from your 401k. Withdrawals are taxed as ordinary income and may be subject to a 10% federal income tax penalty if taken before the age of 59 and a half. And with a Roth IRA, to qualify for the tax-free and penalty-free withdrawal of earnings, Roth IRA distributions must meet a 5-year holding requirement and occur after the age of 59 and a half. Tax-free and penalty-free withdrawals can also be taken under certain other circumstances. The original Roth IRA owner is not required to take minimum annual withdrawals. Did you hear that? No required minimum distributions like a 401k or traditional IRA. Roths don't have those rules associated with them. With a Roth 401k, for example, also, those are offered sometimes with certain employer plans. You can ask if they have a Roth K option. Employer matching with pre-tax dollars is not distributed tax-free during retirement. So keep that in mind as you go. But the key is start saving early, start saving often, even start at small amounts. You don't need a whole bunch of money to be able to get going. And the longer you're in an investment and a vehicle like that, deferring taxes and growing your money, the better off you're going to be when you get to those older ages of 59 and a half to 70 to 80 throughout retirement. It's going to be huge for you. Millions of dollars difference, especially if you get started early. So compared to, say, starting when you're 40s or 50s and trying to play catch up. All right, you heard it here. Roth IRAs, take a look at them, Google them, go out to Investopedia, educate yourself. And if you have questions, you can always reach out to Northbound Wealth Management. We'd be happy to answer any questions you have. Hey everyone, this is Brent Foster, and I just want to give you some market thoughts. The equity markets, after the trade war fears and woes that happened back in April, the market hit a near-term bottom and then has completely rallied after that. This V-shaped recovery has been hated by a lot of people. There's a lot of institutional wealth that has been sitting on the sidelines that got out when the trade war and tariffs was ramped up by President Trump, and that money was slow to get back in. So the retail investor and most investors that are paying attention to markets who kind of bought on the dip are the real winners in this situation year to date in 2025. So I just want to say that it's now that we're at all-time highs again, it's good to look at your asset allocation, look at what you're invested in, review where your concentrations are at, and know that the market's not just concentrated in like 7 stocks anymore. The market is broadening out as far as other companies in the S&P 500 and maybe in the mid cap space are getting a bid, and those are starting to go up and have been going up actually for the last year. So it's kind of nice to see that marketing broadening out. It's a good thing. And it helps when more than just a top group of stocks start to participate. And with the adoption and of artificial intelligence and the technological revolution continuing in that space, and more capital going that way, capital spend is huge in that space. And then monetization later, it's going to permeate the AI adoption is going to permeate throughout other industries. And we're already starting to see that as more and more people use AI, large language models, and things like that. So wanted to just say that the SP, the NASDAQ, the Dow, all of those are participating in this. And you're not seeing all one of them or two of them, those indexes not participating. So pretty exciting time that we live in. And it looks like the trade war tariff stuff was overdone. Inflation, CPI is relatively low. Looks like it's lower than what the Fed wants to admit. The Fed should lower interest rates. Hopefully they do so later on this week. And that'll be another catalyst for the markets actually to melt up or go higher from here. And you don't want to miss those days where the market has momentum and is rallying, because very rarely do you ever get those price points back over an extended period of time. The markets go up and to the right, typically in 5-wave to 7-wave patterns. And there are certain cycles that last for quite some time. And looks like the AI machine is working in a big way. And it's exciting to see all the efficiencies that'll come from that. And also the cybersecurity space is going to pick up even more. And you're going to, hopefully we pray that there's not any really bad knock-on effects, so that come out of this. Hopefully people keep their heads and do a good job and do the right thing. It's really an interesting time to live in. I hope you guys enjoy it, participate in it, always be buying, investing, saving, budgeting, and investing in the stock market. Here at Northbound Wealth Management, we love the stock market. We think it's one of the greatest wealth creators that there can be. So that and real estate. So if you're not invested in the market and want to get started, want to learn how to get going, you can reach out to us at 317-399-1107, 317-399-1107, or check us out online, www.northboundwealth.com. Have a great week and weekend.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. and make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.